Good morning, everyone, and thank you for joining us today. We will wait a few more minutes to allow people to join in, and we will start soon. So let's start now. So good morning again, everyone, and thank you very much for joining today. The International Energy Agency is very pleased to welcome you to this new webinar in the IEA Africa University series. This presentation today will be on the recent IEA annual report on the latest global trends of energy demand and CO2 emissions. As the world enters a second year of the COVID-19 pandemic, the annual Global Energy Review, it assesses the direction of energy demand and carbon dioxide emissions what they are taking in 2021. The latest statistical data and real-time analysis confirm our initial estimates for 2020 for energy demand and CO2 emissions, while also providing insights into how the economic activity and energy use are rebounding in countries around the world, and also what this means for global CO2 emissions. Before giving the floor to my colleague, Tim Goodson, who is the lead author and analyst of this report, I would like to do some scene setting and say a few words on the IEA for those who may not be familiar with our institution. The IEA has been created in 1974 after the first oil crisis. It is an intergovernmental organization that aims at facilitating the coordination of energy policies of its member countries and beyond. Its initial mandate was to ensure the security of energy supply, mainly for oil, in order to support economic growth. Since the past 50 years, the IEA has expanded its expertise to all energy sources. We collect data and do analysis on almost all countries of the world. We look at all energy sector and all technologies. For Africa, we work extensively with AFREC, for example, but also with local governments and ministries. With around 300 statisticians, analysts, modelers, and experts on energy that work within the agency, the IEA can ensure policy advice to its members and beyond. The IEA conveys policy advice to policymakers, and we organize high-level summits. Each year, alongside the African Union, we host a Pan-African Ministerial Summit that gathers ministers from across the continent to discuss key topics. We also work extensively on climate and clean energy transition, especially this year of the COP26 that will be held in November. Through our regular trainings, we work closely with many countries to help them improve their data collection and build models. With the support of the European Union, the IEA is implementing a capacity reinforcement program for 10 sub-Saharan African countries. In this program, for the moment, we do online courses for each country, but we also have several other activities, among which this IEA Africa University, and we also do bilateral work in order to help them improve their data and work on topics such as energy efficiency. I I invite you now to save the date for the next IEA Africa University that will be held on the 10th of June on the Net Zero by 2050 report that was launched last week. And last but not least, if you want to be kept informed of our activities, then do not hesitate to join our WhatsApp group and LinkedIn community. Without any further ado, I give the floor to Tim Goodson, who will share with you the key findings of the Global Energy Review report. Tim, the floor is yours.
Thank you very much, Zakia, and good morning, everybody, or good afternoon, depending on where you are in the world. So as Zakia mentioned, today I would like to give you an overview of some of the recent findings that the IEA analysis is showing on the impacts of COVID-19 on the global energy sector and on different fuels and CO2 emissions, and what this means for potential trajectories for energy demand and CO2 emissions as we look towards the rest of 2020 and beyond. So as mentioned, this Global Energy Review series is an annual publication that the IEA produces around the start of each year, and its aim is to look back at the year before to try and understand what was the evolution of energy demand and CO2 emissions. And it really serves as a very pertinent source of information for decision makers all across the world who want to understand what's happening with CO2 emissions and energy. Are our policies having impacts, and are we putting ourselves on the right trajectory to be aligned with objectives such as achieving universal access to energy, or such as reducing emissions and perhaps getting to net zero in 2050. So that's sort of the context of this publication. But obviously in 2020, we had the COVID-19 pandemic, and suddenly the energy demand world was thrown into turmoil, and lots of governments and decision makers and private sector people were asking us what's happening to energy markets and what can we expect to happen for the rest of the year. So last year in 2020, we produced some analysis early on in the year looking at the impacts of the first wave of COVID-19, and then trying to understand what that might mean for the rest of the year for energy demand and for emissions. And then throughout the year, we produced additional publications. And then at the start of 2021, we produced the Global Energy Review 2021. So the objective here was to look back again at 2020 and understand the impacts of COVID-19, and understand the continuing impacts of COVID-19 in 2021, and what this might mean as we recover and economies boost as economies exit the impact of the pandemic. So now to jump into the details, let's first look at 2020. So what we can see here is that really it was a remarkable year for energy in 2020. We had global energy demand dropping by 4%. So this wiped off the last 4 years of energy demand growth. A decline of this magnitude had not been seen in the last 70 years. So here we can see that it's really only Great World Wars, the Spanish flu, or the Great Depression that have rocked the energy world to such an extent. And if we look at what's happening in 2020, we see that energy demand declined in all major regions except for one, except for China. And this global reduction in energy demand is around equivalent to the combined energy demand of all countries in sub-Saharan Africa. And we can also say it's almost equivalent to the combined demand of France, Germany, and Italy altogether. So if we can imagine just in 1 year wiping the energy demand from all those regions off the global energy demand map. Okay, so if we look at what actually drove these reductions in energy demand, then we really have to start with transport. Because as we all know, as soon as COVID-19 started to spread around the world, governments started putting in place certain measures to limit the propagation of the pandemic. And what that meant is that often our movement was reduced. The freedom of movement that people have, both to move within their country or move within their city, or to move internationally, that freedom was limited. So what we can see here on the left is road transport activity. So the average use of cars and trucks, etc., was cut dramatically. So here we can see it really started to fall in March in many advanced economies, so in the United States and Europe. But China, where the pandemic impact was earlier in the year, had that huge drop of around 70% towards the end of January and the start of February. So obviously this large impact and reduction in transport use means a big reduction in oil use. And the same is true for aviation. As soon as international borders started to be closed, the number of flights globally really dropped. And we saw in April, total global aviation activity declined by a staggering 60%. And then this decline was maintained for much of the rest of 2020. And it meant that across the whole year of 2020, oil use for aviation was 50% lower than the year before. So that's half of all aviation activity just gone in 1 year. So what this meant for oil, now transport usually accounts for around 60% of global oil demand. And so all these reductions in transport usage meant that global oil demand dropped by around 10% in 2020. So in terms of millions of barrels per day, this means a decline of around 9 million barrels per day across the whole year of 2020. But that decline wasn't even. As we can see here, it's really the months of April and some of the earlier months in 2020 that had the biggest impact. And here at the IEA, we call April 2020 Black April for oil, because we saw almost a 30% or 29 million barrels per day drop in oil demand for the month of April. So this meant that oil demand in that month fell to a level that hadn't been seen globally since 1995. So as we can understand, that's just a monstrous reduction in global demand. Now I'd like to speak of other impacts of the pandemic beyond purely just energy demand. So the pandemic also had an impact on progress towards meeting the Sustainable Development Goals, and specifically Sustainable Development Goal 7, the goal of reaching universal access to energy. Now in 2019, India achieved universal access to electricity, and this means that around 3/4 of the global population without access to electricity is in sub-Saharan Africa. Now, the number of people without access to electricity has been decreasing since 2013. There we go. We can see decreasing from 2013 through to 2019. And this is largely thanks to the progress made in several key countries, such as in Kenya, in Senegal, in Rwanda, and in Ghana. But what we saw in 2020 is that some of this progress was being reversed as populations without access to electricity increased again. And in Africa alone, around 13 million additional people were without access to electricity in the year 2020. And globally, the number was around 15 million. Now, this change is due to several reasons. Firstly, the pandemic forced governments to shift immediate priorities and focus on these purely emergency measures, on the health of their populations and on controlling the spread of the pandemic. And so this shift of focus meant that there was a lack of financing available for improving and expanding electricity infrastructure and other electricity access programs. For example, in Uganda, public subsidies to the electricity access program were put on hold, while in South Africa, authorities had to concentrate budgets on health and welfare at the expense of their rural electrification program. And if we look beyond governments, then private companies deploying decentralized energy solutions, such as solar home systems and mini grids, also faced issues. They faced operational and financing challenges, and in large countries such as Ethiopia, lockdown measures meant that distribution chains were disrupted and sales, as a result, reduced by 20% compared to the same period in 2019. And if we look at other markets such as Zambia or Uganda, then disruptions in international supply chains hindered imports. So for instance, if many of the solar home systems that people have been buying were purchased in China or made in India, then suddenly if we had a disruption of global trade and shipping, then we won't be able to get these units to countries within Africa and then to be able to distribute them to people in need. So all this together meant that the number of solar products sold in Africa dropped by 10% in 2020. Now, in addition, the pandemic and its consequences also affected populations that already had access to electricity. Because for many people, the pandemic meant they lost their jobs or they had reduced incomes, and therefore they had less ability to pay bills such as electricity bills. And so by the end of 2020, up to 30 million people who had electricity in sub-Saharan Africa were no longer able to afford these basic electricity services. And so this meant that as we got to the end of 2020, almost 600 million people were living without access to electricity in sub-Saharan Africa, and around 785 million at a global level. So this was about a 2% increase from 2019, so a real step back in progress. Obviously, we need to be going in the other direction to hit universal access to electricity by 2030 for the Sustainable Development Goal 7. Now, one factor that really has been limiting progress is access to finance. Now, it can already be very expensive to borrow money for programs such as energy access programs within Africa, or to borrow money for projects to develop renewable energy sources, etc. But our analysis finds that over the first half of 2020, country risks perceived by investors in Africa went above 7%. So this is an increase of around 1/3 or 2 percentage points. So this meant that it was getting more expensive for companies in Africa to borrow money to finance their projects, such as renewables or other electricity access projects. So money was getting more expensive in Africa, while at the same time in countries such as the United States, money was getting cheaper, with interest rates falling from 2% to below 1%. And so unfortunately, this also affected African countries with the highest needs for progress on access, and they were particularly affected, such as the DRC, the country with the most people deprived of electricity. And it's here where the cost of borrowing rose the most, as those country risks rose. And if we think of what actually drove this increase in country risks, then it's really linked to the uncertainty and the crisis in global economies that was felt during 2020 and that continues to be felt today. So during this time of uncertainty and much volatility in markets, we have many investors who are looking for safe places to put their money. So they're trying to put their money in countries such as the United States or in countries across Europe, where they feel more certain that that money will be repaid, because they know that the government has a large ability to step in and support banks or support other institutions where possible. But in countries where financial risks are higher and governments have less capacity to invest and to support the economy, then these risks are perceived as being greater, risks of default, risks for investors to not get their money back. So it's these sorts of dynamics that unfortunately played out in 2020 to mean that it was more expensive for many African countries and companies to be borrowing money and to be able to put in place these sorts of access programs. Now, if I move forward, as we've seen in the first slide, so coming back to the global picture, total global energy demand fell 4% in 2020. But if we look at CO2 emissions, these CO2 emissions fell further than energy demand, falling by around 6% in 2020. And this is due to the pandemic hitting the hardest demand for fossil fuels. So we've seen that oil demand fell by almost 10% in 2020, and demand for coal and gas also fell strongly in 2020. And so what this meant, if we look at the emissions picture, is that we have this almost 2 gigaton decline in global CO2 emissions. And emissions from oil alone fell by over 1 gigaton, so 1.1 billion tons, in fact, just from oil. And if we look within oil, then road transport accounted for 50% of this decline in emissions, and aviation another 35%. So despite the decline in 2020, nonetheless, global energy-related CO2 emissions remained at around 33 gigaton. And this contributed to CO2 reaching its highest ever annual concentration in the atmosphere. So for me, we can think of this like a bath or a bucket filling with water. Each year, the energy sector is putting more and more water into the bucket, so more CO2 emissions into the global atmosphere. And what happened in 2020 is that we slightly turned off the tap. We reduced the flow a little bit, but nonetheless, we were still putting CO2 emissions into the atmosphere. And so that meant that we had this increase in the concentration of emissions up to around 412 parts per million, parts of CO2 per million in the atmosphere. And to put this in perspective, it means that global CO2 concentrations in the atmosphere have increased by around 50% compared to the start of the Industrial Revolution a couple of centuries ago. Now, if we want to step back and try and understand what this might mean and how emissions globally might rebound after the crisis, then we want to look at what has happened in previous crises. So here we start by looking at what happened in the 2008 to 2009 financial crisis. So that's the first dip we can see just before 2010. Now, looking at the rebound after this crisis, we can see that as economies recovered after this crisis, that recovery was really driven by lots of carbon-intensive consumption. So especially in the United States and in China, we had a huge increase in emissions, and this was the biggest annual increase in CO2 emissions that we've ever seen. And so this recovery sends lessons for what we might have expected going forward from the drop in 2020. And so what we tried to understand is if we had a recovery after COVID of a similar type to what we'd seen after the global financial crisis, then we could expect global CO2 emissions to rise even further and to rise beyond the 2019 peak. So this is obviously not a sustainable recovery. This is not a desired solution. This would be the world returning to a pre-COVID norm and using coal and other fossil fuels as the primary means to continue to meet our energy demand. But what we tried to communicate globally, and especially to global decision makers, is that there was and there remains a second option to recover from the COVID-19 pandemic. If governments chose to put in place solutions such as putting money into energy efficiency, investing in more renewables, or many other programs that could help us reduce emissions, but also help us to support jobs and create jobs for all those impacted by COVID-19, and help us to boost wider economic growth, that all these options could tick all those boxes and drive a sustainable recovery. So the IEA was very strong in coming out and trying to communicate to policymakers the benefits of pursuing a sustainable recovery. And that remains very true. Although if we look, if we fast forward to the end of 2020 and start looking back at what actually happened for the remainder of the year 2020, then we can see the trajectory is not exactly in line with what we would hope to see for a global sustainable recovery. So what we've done for this publication, for the first time ever, is look at global CO2 emissions at a monthly level. So this means tracking energy demand for different energy sources across the world for different countries at a monthly level, and putting all this together to calculate global emissions at a monthly level. So here we can really see that impact of the first wave of the pandemic in April, bringing down global CO2 emissions relative to the preceding year. But what's striking here is that for the rest of the year, global CO2 emissions continued to recover slowly, and by December 2020, global CO2 emissions were already higher than the same month in 2019. So that meant we hadn't even finished the year 2020. COVID-19 was still very present and impacting people all over the world, yet CO2 emissions had already risen above the pre-COVID levels. So that's obviously not at all a good sign for global emissions and for being able to have this sustainable recovery. And if we look at what's actually underpinning that increase that we see towards the end of the year in 2020, then we really see that it's major emitters that drove that increase. Now, I mentioned right at the start that China was the only economy to not see a decrease in energy demand in 2020. And here we can see why. So China was impacted by COVID-19 at the start of 2020, the first country to feel the effects of COVID-19. But by April, energy demand and CO2 emissions in China had already recovered and surpassed the pre-COVID-19 levels. So that meant that for the rest of 2020, there was growth in energy demand and emissions in China. And we know how big the Chinese economy is and their energy consumption, so that really had a big impact on the global numbers. And the story was similar for India. India was very hard hit by the COVID-19 crisis and continues to be very hard hit. And the first wave of the crisis in April of 2020 and all the national lockdowns in India really pushed down emissions. And we saw the biggest, the steepest decline in emissions of any country in India. But as we can see, this red line by September of 2020 had already surpassed the 2019 levels. So emissions in India had already pushed above those pre-COVID levels. The same was true for Brazil, emissions recovering later on in the year, and even in some advanced economies, and here the United States, despite the continued big impact of the pandemic, we had emissions coming close to 2019 levels by the end of the year. And I should note that in the United States, it's not just the recovery of economic activity, it's also weather effects. If you have a very cold month in December, then that means people are using more energy to heat their homes. Or at the same time, if you have a very hot summer, they might use more electricity for their air conditioners. So this all leads us to ask the question, what does this mean for the year 2021? We've seen that we're on this trajectory with global emissions rising and surpassing 2019 December levels by the end of 2020. And so that might lead us to think that we'll just continue on that trajectory and emissions will rise further and further in 2021. So these are the type of questions that we aim to answer with our analysis in the Global Energy Review 2021. Now, the first place to start for this sort of analysis for us is to look at projections for global economic activity throughout the year. So we've seen this huge hit to global economic activity in 2020, and now in 2021, as the COVID crisis starts to be controlled in certain areas of the world, and there's lots of money coming into certain economies, we see a return to growth, a return to activity. So here we use the projections of the International Monetary Fund. And what we can see strongly is that in Africa, we have a growth of around 3% in 2021 relative to 2020 levels. So that's good, strong growth across the African continent for economic activity. But it's only just enough to offset the hit to economic activity that the African continent experienced in 2020. And so this right figure really shows that economic activity has only just surpassed those pre-COVID levels in Africa. And if we compare this to China, then we really see the impact of China continuing to grow its economy in 2020 and then growing even faster in 2021. So that it means that by the time we get to the end of 2021, the economy in China is around 11% greater than the size of their economy before COVID. And so obviously we need to take into account all these projections of economic activity to then understand how energy demand might evolve in the year 2021. And another thing we also need to consider is policies. For instance, if a country in 2020 put in place a policy that said, we want to develop lots more renewables or we want to stop using coal, then we would have to take that into account and make sure that the reality of that policy being realized and impacting the energy sector translates to the numbers that we see in our modeling. Now here to look at the results from that modeling, the first thing we notice is that it's oil that leads the increase in energy demand in 2021. Oil demand in 2021 is expected to rebound by 6%. And that would mean growth faster than the growth for all the other fuels. The last time oil demand increased at this rate was in 1976. So this really is unprecedented in the last few decades to see this level of increase in oil demand. Then second, we have coal. So coal demand in 2021 is expected to rebound strongly, and China alone is expected to account for well over half of this increase in coal demand in 2021. And this picture really tells us that the recoveries aren't as sustainable as we would need them to be, as we would like them to be, because coal is increasing 60% more than renewables in 2021. And so that means that renewables aren't able to meet this increase in energy demand in 2021. And that means that policies or that economies are using instead coal and oil to meet that energy demand. So it's really a return to normal as people jump back in their cars, as coal-fired power stations or industries are fired up, and we're heading back towards pre-COVID levels. And this figure really tells that picture just for fossil fuels. So firstly, if we look at the demand for oil, then we can see that despite this annual growth that we expect in 2021 of 6% for oil demand, it's still not sufficient to push global oil demand above the pre-COVID levels. Oil consumption for road transport is not expected to reach pre-COVID levels until the end of 2021. So that means that due to continued containment measures and the continued impact of COVID in many economies across the world, that people aren't jumping back in their cars or driving trucks as much as they were before COVID. And it's really only at the end of the year when many more people have been vaccinated, where COVID is less impactful on our activity, that global road transport demand will return towards pre-COVID levels. Now, the story here is very different for coal and gas. Demand for natural gas is expected to grow by over 3% in 2021. And this is propelled by growth in demand in Asia, in the Middle East, in Russia, and in Africa. So this is expected to push global demand more than 1% above those 2019 levels. So that means that emissions from gas are rising higher than they were pre-COVID. Now for coal, we expect the recovery in economic activity to reverse these declines that we saw in 2020 and push demand 4.5% higher, just above 2019 levels. And if we look at coal in a little more detail, then we can really see that it's China that is leading the increase in global coal demand in 2021. Now, globally, the electricity sector, so using coal to generate electricity, accounted for just over 40% of the drop in coal consumption in 2020. And so this was due to many countries such as South Africa, such as the United States, the European Union, having a lower electricity demand in 2020 due to COVID, and reducing the generation from coal to account for that lower demand. And so we had this drop in coal demand from power generation in 2020, but if we look forward to 2021, then we can see the rapid increase in coal-fired power generation, particularly in Asia, accounts for most of the rebound and undoes the drop that we saw in 2021. And another factor to take into account here is the different price dynamics between natural gas and coal. For instance, if I have a power station and natural gas prices and coal prices are quite similar, then based on those prices, I might choose to operate either a coal-fired power station or a gas-fired power station. So what we're seeing is companies choosing between those two options based on price dynamics. And as natural gas prices increased in the end of 2020 and 2020 and continue increasing in 2021, then it becomes more attractive for utilities to use their coal plants to generate electricity. So this also increases coal demand to a certain extent. But what we've seen is it's really China that is the only major economy where demand for coal grew in 2020 and then grows again in 2021. So it really shows that the stimulus measures post-COVID in China have been sufficient to support electricity demand and therefore coal use for electricity, and also drive strong growth in coal-intensive industries such as steel production, cement production, and many others. And as other economies such as the United States, India, or the European Union start to return to economic growth and demand more products, this also feeds into increasing energy demand in China to create some of those products. Now, I'd like to step back away from coal and here look more regionally at total energy demand and how it's changed throughout 2020 with the impact of COVID, and now as we recover in 2021. So what this is telling us, let's focus on the dot of Africa right in the middle here. The fact that Africa is below that horizontal black line is telling us that energy demand in Africa declined in 2020. So the impact of the pandemic meant that energy demand in Africa fell by almost 2% in 2020. And if we look at the horizontal axis, the fact that Africa is right of the vertical line means that in 2021, energy demand in Africa grew enough to reverse all the declines in demand of 2020 and push Africa above pre-COVID levels for energy demand. So we can really see that it's mostly emerging market and other developing economies that have seen this recovery in energy demand above pre-COVID levels. And especially China, which had no drop in demand in 2020 and continued growth in 2021, that is right out front there. But if we look at to the bottom left corner, we can see that for advanced economies, the picture is very different. The impact of the COVID-19 crisis was more pronounced with prolonged lockdowns in the United States and the European Union. And so this meant that energy demand fell by between 6, 7, 8% for certain economies during 2020. And that demand hasn't been able to recover in 2021 because the crisis continues in many places. And there's not the same return to the pre-COVID normal in those economies. So now if we jump away from energy demand in 2021 and really look at the picture of CO2 emissions. So this is what really interests us and what drives most of this analysis is to understand what's happening to CO2 emissions and what can we expect for the rest of 2021. So here to start with, we see that decline of almost 2 gigatons, so 2 billion tons of CO2 emissions, around 6% of the global total in 2020. And in 2021, we expect an increase in emissions of around 1.5 gigatons, so 1.5 billion tons of CO2. This would make 2021 the year with the largest single increase in CO2 emissions since that economic recovery from the last financial crisis we saw earlier. And this would leave global CO2 emissions still around 400 million tons or 1.2% below their 2019 peak. But it's very important to look at the drivers by different fuel to understand why we're staying below this 2019 peak. So here we can see that, as mentioned earlier, CO2 emissions from oil demand dropped by over 1 gigaton in 2020, but in 2021, they are not expected to increase and recover all that drop. So we only have an increase of around 650 million tons in 2021. So this means that the oil-related emissions only recover around half of their drop and remain about 500 million tons below their 2019 levels. Now, this only partial recovery in emissions from oil is really just due to the fact, as we've discussed, that through 2021, there were still impacts and there are still impacts of the COVID-19 crisis. So people are still limiting their use of their vehicles. Still, there's limits to global freight use. And very importantly, global aviation has not recovered. Now, not many people or people really aren't taking an aeroplane to the same extent that they were before the COVID-19 crisis. So these impacts on road transport and on global aviation are really weighing down and preventing oil demand from rising back above or back to pre-COVID levels. So it's very important to note here that it's purely these activity impacts, so the continued impact of COVID, that's stopping CO2 emissions rebounding. There has not been sufficient structural changes to the economy globally to prevent this rebound in emissions once activity recovers. So that means that we haven't seen the policies needed to prevent a rebound in emissions. We haven't seen increases in energy efficiency or in deployment of renewables or uptake of electric vehicles that would be fast enough to prevent this rebound in emissions. So the clear message there is that we need stronger policies to help our economies become less emissions intensive and more efficient and use more renewables into the future. And I'd like to finalize this presentation with some more optimistic pictures after that quite pessimistic outlook for 2021 and global emissions. So here we've seen in 2020 that all energy sources saw a drop in demand, all except one, all except renewables. Renewables increased their use in 2020 by 3%, while every demand for all other sources dropped. And if we look at what drove this increase in renewables demand, it really was the increasing generation of electricity from renewable sources, such as hydroelectricity, solar PV, or wind. So on this figure, we can see solar PV and wind, the purple line in 2020, they had a record year for deployment. It was the biggest year of annual increase in generation from solar PV and wind ever in 2020. And if we look forward to 2021, then we can expect to see another record increase from solar PV and wind. So it really shows that we're on this increasing trend with global generation from renewables rising rapidly. So this gives us cause for optimism and cause for hope that we can increasingly decarbonize the global power sector. And this is evident, the progress is evident on this figure. So this is showing the share of different fuels in the global power mix. And we can see that increases in electricity generation from all renewable sources push the share of renewables in the electricity mix to an all-time high of 30% in 2021. So if we add to this 30% from renewables, the 10% that comes from nuclear at a global level, then we get to 40% of global electricity is generated by renewables or other low carbon sources. So this is the highest share that we've ever seen. And what's clear here is that brown line, the share of coal, is falling below the share of low carbon sources. So we're seeing a big transition in the global power system where despite certain economies having a continued increase in generation from coal, globally the picture is that the share of coal is dropping and renewables are rising. And I'd like to finish on this same picture, but just for Africa. So we can see at the level of the continent of Africa that renewables, they're growing rapidly, but they still haven't passed the share of coal in total electricity generation. But that share of coal is dropping rapidly and renewables are rising just as rapidly. So increasing generation from hydro across Africa, from the expansion of wind and solar parks or from geothermal sources are all helping to build a renewable base of electricity generation in Africa and helping to extend availability of electricity and solutions such as small mini grids or home solutions of solar PV. These are all critical in expanding electricity access and are really on the right path there. All the while, coal demand continues to provide valuable electricity, but its share will continue to drop into the future. So I'll leave it there, and I'm very happy to discuss any questions that you might have on the presentation.
Thanks a lot, Tim, for this very interesting presentation with strong messages. It was very interesting to see how the pandemic has affected the energy sector, how energy demand and supply has changed. And also it was quite depressing to see how hard it is and challenging it is to reduce CO2 emissions in a sustainable way. For the participants, if you have any questions for Tim, please use the question and answer box to write down your question, and we will be happy to reply to any question you may have. We have around 15 minutes for questions, so please do not hesitate to send your questions for Tim and me. In the meantime, maybe Tim, we can say maybe if well, I think we already have a question arriving. How do you get the data for the modeling?
That really is the golden question, and absolutely, particularly for Africa, how do you get the data? So already, and Zakia can speak to this as well, it's very difficult to get official statistical data for countries across Africa, and not just Africa, for many countries across the world. And there's only a certain amount of countries that report official statistical data to the IEA. And then the IEA does a lot of work with other countries to try and find data and looking not just at official sources, but at different market sources that might tell us how much oil is being imported or how much gas is being sold, etc. So that's already a lot of work done for statistics for the historical years. And now for this exercise, we need to find data not just for years such as 2019, but much more recent data, so for 2020, and then even for the early months of 2021. And so that means a lot of work from teams across the agency looking at either different official statistics where they exist, so that's often for advanced economies or for electricity sectors, and then where we can't find those statistics, looking at different markets and trying to work with people who might be present in those markets to understand what trends are happening there. So it's really a lot of data scraping online, a lot of contacting people, and from teams across the agency focusing on different fuels, using all their networks. So unfortunately, there's no easy answer there. It's really just a question of looking where we can find that data and understanding the trends. But there's definitely no one source of data we can go to, unfortunately.
Yes, exactly. As Tim mentioned, it's a lot of compiling different sources together and trying to get the picture of of what's happening in the region. Sorry, and indeed we do receive official data in the statistics division up to year -2, so up to 2019, and then for 2020 and 2021 we rely a lot on other sources. We rely on daily, weekly, monthly data, especially for electricity generation. That's easier to get, and for the other fuels, for example, natural gas production, coal, etc. We look also at capacity. We look at the trade between countries, and then we couple all these information and together. And this report is done. It's a whole interagency report. So we have our expert in the different fields. We all sit together and we build the energy balance in the most complete way. We have a few other questions arriving on electric cars in Africa.
Yep. Yeah, so just a comment on the conversion or the switch to electric cars in Africa, current and future. So if we look at 2020, then firstly at a global level, we see that around almost 5% of global passenger car sales were electric vehicles. But for Africa, this share remains below 1%. And so there's many factors at play there. There's not the policy support for the adoption of electric vehicles in most countries in Africa. Secondly, there's the cost element, the fact that electric vehicles remain very expensive for most people. And the third point is the availability of a reliable supply of electricity. So in many cities across Africa, having a reliable supply is not too much of a problem, but that reliability still might not be sufficient to convince people to buy an electric vehicle. And especially in certain countries and outside of major cities, we can often have important blackouts, which mean that you cannot have the guarantee of being able to charge your vehicle when you need. And if we project forward, then yes, there will be a rapid uptake of electric vehicles if there's the policy environment to support that uptake. But what we would see is much more likely is to have a more rapid uptake of electric motorbikes or scooters or lighter vehicles, because these vehicles require less investment. It costs less to buy them. and at the same time they use less electricity. So they're putting less strain on power systems in Africa, which often today are still struggling to meet electricity demand and struggling to expand demand to connect households that don't have access at the moment.
Thanks.
So we have another question.
Is the model available for public, and will the presentation be available? Yes, on the presentation, we will put everything online on YouTube. You will have access to this recording of the session, of the webinar, and as well as a link where you can download the presentation. And on the model, you want to reply to
Sure.
this?
So on the model, what's being used here is really just an aggregation of historical statistics from the IEA's Energy Data Center and from data coming all across from different teams of the agency and bringing that together. So the strength of the model that we have is the data inputs that come from our network. So the model itself is not something that's very valuable in isolation, I would say. So unfortunately, we can't share that model, but through, I guess, some of the modeling trainings that are available, we're certainly able to help explain how such models can be developed and how they can be developed to fit your purpose, your needs. And certainly, as Zakia mentioned, this presentation will be available and the slides as well if needed. I see a question on other renewables. So I guess looking at the last slide that we said, other renewables for Africa are increasing up to 2021. What percentage is modern biomass and how much is traditional biomass? So just a precision on that last slide, that was looking at the share of energy in electricity generation, not the total share of energy in total energy demand. So for electricity generation, other renewables for Africa, it's very much just majority hydroelectricity with some geothermal electricity, such as the geothermal plants in Kenya, and also some solar thermal, such as the solar thermal plants in North Africa and Morocco. But really the majority there is hydro, and there's, to my knowledge, very little bioenergy used for electricity generation in Africa at the moment.
Thank you. We have another question on the access to the raw data. So as again, Tim mentioned, it's not, it's a lot of compilation of different data sources, so it's not easy for us to share our original data sources.
I think, yeah, the best bet for data there is the official statistics published by the Energy Data Center at the IEA. So they're not going to be for 2021, they're not going to include these projections for 2021, but you will have recent years available there.
Yeah. There's a last one on, is there a particular model equation you use for predicting and validating energy demand?
So here, what we're doing in terms of the modeling framework for projecting is really just looking at the most granular detail possible. So for instance, looking at China, the steel sector, or the cement sector, or that sort of granularity, and looking at what are the projections for economic activity. So for instance, if steel sector value added is projected to increase by 10%, in 2021, then we would just look for this exercise at the elasticities previously. So what happens to demand from that sector if we increase output by 10%? So we're using just a much more simplified elasticity-based model for this exercise of projection. And that only works because we're doing a projection on a very short time scale where there's not big impacts of policies that are starting to shape demand trends. But as you'll hear when you have the presentation for the net zero emissions report, then the modeling that's underpins that sort of report is very different. It's a bottom-up modeling, looking at what's happening in terms of energy service demand and what technologies are being used to meet that service demand across all different sectors and regions. So different approaches there. And just the final part of that question, this sort of approach, short-term projections based on elasticities at this level of granularity, it's been validated, and it's what's used for our medium-term market reports for the short projections as well. And so that's the most robust approach that we can bring there. As a question on, has the IEA carried out petroleum demand projections for, say, the next 10 years? So we do have oil demand projections by different products. Well, firstly, we have projections for the next 5 years, and that's in our oil markets report. And so that's available on the IEA's website. And so these projections are made using a modeling structure that similar to the one I just described, looking just out for the next 5 years and how oil markets and prices will evolve. And then we also have projections on oil demand for a much longer time frame, say out to 2050. And that again is using this bottom-up modeling. So for instance, for the World Energy Model, it supports the World Energy Outlook. So you can find those projections in the World Energy Outlook, and they'll be based on different assumptions on what scenario we're in. So what type of world we're looking at.
Yeah. I think we replied all questions. I don't know if any participants would like to ask 1 or 2 more questions. We have 2 minutes left before the end of the session. Thanks a lot for the questions. We received quite a few. And this publication, we didn't say it, but it's you can download it freely on the IEA website, as well as the previous year's Global Energy Review. And it's really interesting for comparison.
Thanks, Zaki. I'll just send a link to the Global Energy Review in the chat. Where is it? Here we go. Yeah.
And if you have any questions, even after the presentation, do not hesitate to write to me or to Tim, and we will be happy to get back to you after. So yes, in the chat box now you can see the link to the report that you can download freely. And yes, so if we don't have any more questions, that's the end of the webinar today. Thank you everyone for listening to us. And thanks a lot, Tim, again for joining us today and sharing your this presentation with us. And see you next month in June for the net zero emissions report. Bye, everyone.
Thank you. Goodbye.